as I expect the price of gold to eventually go way up and the price of Bitcoin to keep falling, dragging down the price of the Grayscale Bitcoin Trust. But getting back to the stock markets, there are some very obvious reasons that stock prices are going down. And fundamentally, they still have a long way to fall. And it's amazing that so many so-called experts don't recognize the extent to which equity prices are at risk and how much lower they actually have to fall to the extent that the Fed actually follows through with what it is claiming it's going to do with interest rates and this inflation fight. Because higher interest rates directly destroy stock market valuations. And there's 4 principal reasons for that. So let me go over those reasons so it's perfectly clear why what is happening right now with interest rates is very bearish for U.S. stocks. Even though they've already gone down quite a bit and are in bear market territory, they still have a long way to fall because remember, stock prices were propped way up as a result of inflation and artificially low interest rates. So when you try to remove that inflation by raising interest rates, then prices are going to have to come crashing down to a level consistent with this new environment that companies are operating. But one of the reasons that high interest rates hurt stocks is because a lot of stocks have debt. And if you are a company and you have debt on your balance sheet, which of course corporations have record amounts of debt on their balance sheets, thanks to the Fed keeping interest rates so low for so long, lots of companies took advantage of cheap money by going into debt. And then what do they do with the money? They use it to buy back stock. But they bought back stock at inflated prices. In fact, as the stock market collapses and a lot of this debt comes due, a lot of these companies are going to be sitting on unrealized losses. They would have paid higher prices for the stock they bought, but now the money they borrowed to buy it is going to cost a lot more to service. And so as corporations that have debt have to pay bondholders more money to service that debt, that directly reduces corporate earnings. And the only way corporations may be able to deal with that debt is by repaying it. Well, how are they going to repay debt? Well, they have to unwind those stock buys. They have to take the stock they bought and sell it into the market to get the money to pay off their debt. But of course, when companies go from share buybacks to share sellouts, the share prices are going to collapse. And in fact, companies will probably have to sell more shares than they bought because the price is down. And so this weighs not only on their stock price, but on all stock prices. Now you have all this selling. A big driver of the bull market has been buybacks. Well, a big driver of the bear market is going to be sellouts as all the stock that was bought back gets dumped back on the market. There's another way that higher interest rates also affect corporate earnings, and that's because corporations have customers that also have a lot of debt. And so as their customers have to pay more money to service their debt, they have less money available to purchase the goods and services that a corporation may be selling. So not only are its earnings under pressure from its own increase in interest rates, but its earnings are under pressure because of its customers' increase in their interest rates. So earnings are collapsing as interest rates are rising. And stock prices, of course, are a function of future earnings. You have to discount future earnings into the present. So if those future earnings are going down, the present value is going down. But also, and this is another big reason that high interest rates hurt stock prices, is when you compute the present value of a future earnings stream, you have to discount it by an interest rate. Now, the lower the interest rate, the higher the present value of those future earnings. Now, as the Fed is raising interest rates, now you are diminishing the value of those future earnings. So not only are corporate earnings collapsing, but the present value of those diminished earnings is also collapsing. So rising interest rates actually deliver a double whammy to stock prices. Another way interest rates are going to hurt the stock market is by pushing the economy into a recession. And when we're in recession, there's also going to be huge job losses. And so all of those job losses are going to mean that a lot of customers are going to have a lot less income to spend buying the goods and services that companies have for sale. So earnings are just going to implode for all sorts of reasons. Debt service costs are going to explode. This is a disaster for the stock market. And of course, as interest rates rise, a lot of companies aren't just going to have trouble paying their debt. They're not going to be able to pay their debt. They're going to go bankrupt. And so a lot of these bankrupt companies are no longer going to be buying any goods and services from businesses that they used to patronize. And of course, the systemic risk is going to be there, because when a company goes bankrupt and it can't pay its bills, now the company it owed money to isn't going to get paid. And so now maybe that company can't pay its bills either, and so on and so on. That is the type of systemic risk that caused the Federal Reserve to do quantitative easing in the first place. That's why we had all the bailouts in 2008, because we had all these banks that were too big to fail. Why were they too big to fail? Because if they failed, it was going to send shockwaves throughout the economy because of how interconnected everything was, and because of all the systemic risk. You let one big bank fail, it's just one domino, and now all the rest are going to go. Well, is the Fed going to do the right thing in 2022 or 2023 when it didn't do the right thing in 2008? What is the only reason that the Fed did the wrong thing? The wrong thing was slashing rates to zero and doing quantitative easing. Why'd the Fed do that? Because if it didn't do it, it was going to allow a lot of short-term pain. By doing it, it traded long-term pain for some short-term gain. In fact, the Fed made the same bad trade-off in 2020 at the onset of the COVID crisis. Instead of allowing the economy to endure the pain of dealing with the crisis, it slashed interest rates back down to zero, launched a massive quantitative easing program to postpone that pain. So again, it was short-term gain, but only at the expense of long-term pain. Well, the long-term pain is the pain that we're about to endure now. But the Fed had no stomach for pain in 2008 or in 2020. So they just postponed it to some future date by creating inflation. Well, now they're going to be in the same predicament that they were 12 years ago and 2 years ago, only now they're staring at a much greater crisis with even more pain. Why would they do the right thing now when they weren't willing to do the right thing back then? Why wouldn't they once again trade long-term pain for some short-term gain? That is exactly what I think they're going to do. I think the Fed is basically going to say, you know what, inflation is bad, but it's not as bad as depression. It's not as bad as a financial crisis. And so even though inflation is not down to 2%, because we now have a much bigger problem than inflation, we're going to solve this problem the same way we solved the problem in 2008. We're going to slash interest rates. We're going to do quantitative easing, which will send the dollar through the floor and inflation through the roof. We're not going to have another 12 years of phony borrowed prosperity. Yes, the Fed will be able to buy itself some time, but it may only be months, not years.